What if, just imagine, a single treatment could actually reverse a devastating rare disease? I mean, the impact, it's huge, right? For patients, for
It
families.
really is. That's the bleeding edge of gene therapy.
Exactly. And that brings us to Rocket Pharmaceuticals ticker RCKT. They're right in the thick of it.
hmm A really key player.
And they're facing some critical moments, clinical data coming, big regulatory decisions. It could completely change their trajectory. It's a story of massive potential, but also, let's be honest, significant risk.
Definitely. So Rocket Pharmaceuticals, like you said, clinical stage biotech, their whole game is gene therapies.
But not just any gene therapies.
No, specifically for rare, really tough diseases. The kind where patients don't have many or sometimes any good options.
And crucial point here, they're pre-revenue. No products on the market generating sales yet.
Right. Still very much in that development phase.
Okay, so for this deep dive, we've really dug into this report. RCKT Deep Research, 2025 tariffs. It's dense.
It is. Lots to unpack.
So our mission today is basically to pull out the absolute must-knows, the business itself, who's running it, their financials, what it might be worth, the hurdles.
And yeah, even how those new U.S. tariffs might play into it.
Exactly. Think of this as your shortcut to getting up to speed on a pretty complex company. We're aiming to give you that informed perspective.
So where should we kick things off?
Let's start with the fundamentals, understanding the business itself. Chapter 1.
Makes sense. Build that foundation.
Okay, so Rocket calls itself a, quote, fully integrated late-stage biotech. Very specific mission, gene therapy cures.
Cures, not just treatments. That's ambitious.
For rare disorders with high unmet needs. And their strategy is interesting. They don't just stick to one tech.
Right, they've got this multi-platform approach. They use both AAV vectors
The adeno-associated virus, yeah. For in vivo inside the body.
and LV vectors, lentiviral, for ex vivo. So modifying cells outside the body and putting them back in.
And they're really targeting tough areas, devastating diseases of the heart and bone marrow.
Areas with huge unmet needs, like you said.
Right.
They also list these core values: trust, curiosity, generosity, elevate. Gives you a sense of their culture, maybe.
Strategically, focusing on rare diseases is pretty clever, isn't it? You get potential perks like orphan drug status, fast track.
Priority review, potentially. Yeah, it can really accelerate things on the regulatory side.
But the flip side, the research points this out, is smaller patient numbers for each disease.
Which makes that idea of a sustainable pipeline absolutely critical. They need multiple wins, not just one home run.
And this fully integrated piece, including their own in-house AAV manufacturing CGMP standard. That's a big undertaking, right? Especially in gene therapy.
Oh, absolutely. Manufacturing is often a huge bottleneck.
Yeah.
And costly.
So having their own AAV CGMP facility gives them more control over timelines, costs, quality.
Exactly. It significantly de-risks things. They're not just waiting on a third-party manufacturer who might have other priorities. It's a major strategic advantage if they execute well.
Okay, so this dual platform, AAV and LV, let's break that down a bit more. The AAV stuff is mainly for the heart condition.
Correct. That's Danon disease, PKP2-ACM, and BAG3-DCM, all in vivo. The gene therapy goes straight into the patient.
And the LV vectors.
That's the ex vivo approach,
Oh.
mostly for blood disorders like Fanconi anemia and LADI.
So they pick the best tool for the job, basically. Platform agnostic.
Seems to be the strategy. And they're not afraid to partner up, like their collaboration with Reagenics Bio for Nevi technology.
And IP, intellectual property, must be king here. The report mentions 42 granted patents, 13 pending as of 2023, covering things like Danon and cardiomyopathy. Sounds solid.
It's definitely a crucial foundation, but managing two very different, very complex platforms like AAV and LVV, that's a heavy lift.
Different manufacturing needs, different biology.
Different regulatory paths, too. It demands a lot of expertise, a lot of resources. And while they have the in-house AAV, the LV side seems more reliant on partners, which brings its own dependencies.
Okay, let's pivot to the main event for many investors, the pipeline. What's cooking? Starting with the heart programs.
Right, the AAV side, RPA 501 for Danon disease, looks like a lead candidate.
They finished enrollment for the phase 2 pivotal trial, right? Update mid-2025?
Yep, update mid-25, full data expected mid-26. But what's really exciting is the phase 1 data they already have.
The long-term stuff, published in the NEJM.
Exactly. Showed safety and, importantly, durable efficacy up to 5 years out. That's groundbreaking for an AAV therapy in a cardiac indication. First time we've seen that kind of long-term result.
Wow. And the market size estimate?
Around $150 million annually. Plus, they have RMAT designation from the FDA, which helps streamline things. 5 years durable efficacy. That's a big deal.
Definitely. Then there's RPA 601 for PKP2 ACM. Phase 1 ongoing.
Underway, yes. And initial data is expected very soon, May 2025. This one targets a much larger group, maybe 50,000 patients in the US and EU.
And they got orphan drug status in Europe for that one, too.
Correct. And don't forget, BG3-DCM, the one they picked up from Renovacor, they're aiming for an IND submission mid-2025. So, yeah, a lot happening on the cardio front.
Okay, switching to the hematology side, the LVV platform. RPL-102 for Fanconi anemia.
They've started a rolling BLA submission with the FDA.
Rolling BA, so they submit parts as they're ready. Speeds things up.
Potentially, yeah. They hope to finish the last module late 25 or early 26. The EMA review in Europe is also happening, and they have prime designation there. Market estimate here is maybe $150, $200 million a year.
And then there's Kresladia, RPL-201 for LDI. This one's got a bit of drama.
Well, the BLA is under review, but the PD-LVV date got pushed back. The FDA wanted more CMC infochemistry, manufacturing controls.
Manufacturing again, complex stuff.
It really is. As of February this year, that review is still ongoing. The CEO mentioned it's a smaller market opportunity.
But the regulatory outcome feels really important for validating that whole LVV platform, doesn't it?
Absolutely. A win here would be a huge confidence boost for their ex vivo tech and their ability to handle FDA's manufacturing scrutiny. A delay or rejection, though, that could cast a shadow.
So you've got these staggered catalysts, lots of moving parts. Seems like the AAV cardio programs are maybe the top priority now.
It looks that way.
Yeah.
They probably see those as the biggest potential value drivers near term.
Okay, so if they're pre-revenue, how do they keep the lights on? And what's the plan for actually making money eventually?
Right now, it's mostly equity offerings, selling stock. They've had some partnerships, but nothing bringing in revenue yet. The whole model depends on getting these therapies approved and then actually selling them.
Those market size estimates give a clue to the potential.
Exactly. RPL 102, RPA 501 could be significant. And you see their G&A costs rising. That's them building the commercial team, getting ready to launch if they get the green light.
Makes sense. You have to be ready. But gene therapies, they come with massive price tags, right?
Yeah.
How do they plan to handle reimbursement?
That is the million-dollar question, or maybe multi-million-dollar question here.
Yeah.
They're doing the health economics work, the outcomes research. The argument is value-based pricing.
So yes, it costs a lot up front, but it saves money over a lifetime compared to managing the chronic disease.
Precisely. They're talking potential savings of maybe $1.5 to $3 million per patient over time for some of these conditions, proving that long-term economic benefit is absolutely key to getting payers on board.
Okay, competition. For Danon disease, RPA 501, you said they seem to be leading.
Yeah, the research suggests they're in a pretty strong spot there. Maybe a first-mover advantage in gene therapy for that specific heart condition. Doesn't seem like there are other gene therapies quite as far along.
So the main competition is just the current standard of care.
Which, unfortunately, isn't disease-modifying. So, yeah, for now.
What about Fanconi anemia? RPL 102.
That space is a bit more active. Rocket's a key player with their LV approach. 4C Pharmaceuticals has an oral drug, but it works differently. And, the broader field is looking at CRISPR, other gene editing tools.
So they need to keep showing strong, durable data for RPL 102.
Definitely. Efficacy, safety, long-term results will be critical to stay ahead as that field evolves.
And the regulatory environment. We touched on FDA, EMA, the designations they've got. What are the big picture hurdles for a company like this?
Well, engaging constantly with FDA and EMA is just table stakes. Those RMAT and PRIME designations are great, but the landscape for gene therapies is still, developing.
Different expectations sometimes, long follow-up needed.
Exactly. FDA and EMA might want slightly different things, especially for long-term follow-up, sometimes 15 years or more. And that Kresladia PDUFA delay really highlights the intense focus on manufacturing. It's incredibly complex.
Doing submissions in both the U.S. and Europe doubles the work, too.
It does, but it also maximizes their potential market down the road. It's a necessary complexity.
Okay, so we've got a good handle on the what the business, the science. Let's talk about the who. Chapter 2. Management. Who's steering the ship?
All right. The CEO is Dr. Gaurav Shah. He's been there since early 2018. Importantly, he came from Novartis and worked on Kymriah.
Kymriah, the KRT therapy, so he knows this advanced therapy world.
He definitely has that direct experience. The rest of the exec team seems fairly stable, average tenure around 4.4 years. Board chair is Roderick Wong from RTW Investments. They were involved early on.
And didn't they add someone significant to the board recently?
Yes, huge addition. Michael Dolston, former head of R&D at Pfizer, joined in September 2024. That's serious R&D firepower and strategic oversight.
So you got Shaw's cell therapy background and Dolston's big pharma R&D leadership. Seems like a good mix.
Potentially very powerful, yes.
How are their incentives aligned with shareholders? What about compensation and ownership?
Always important to check. CEO Shaw's 2023 pay was about $8 million, but over 92% was equity-based. So his fortunes are tied to the stock price, generally speaking.
Does he own much stock himself? Yeah, decent chunk. Around $8 to $9.6 million worth, depending on the share price. And we saw some insider buying recently.
Oh, who is buying?
Both CEO Shaw and the president, COO, Kanari Patel, bought shares in April 2025. That's usually seen as a positive sign, insiders putting their own money in.
But you mentioned his pay was maybe a bit high.
It is on the higher side compared to CEOs at similar unprofitable biotechs, something investors might watch. Also, while there was recent buying, if you look back over the last 18 months, there's been more net selling by insiders overall.
Okay, so mixed signals there. How are they spending the money they have? Mostly R&D.
Primarily, yes.
Yeah,
R&D
yeah.
is the big one, advancing the pipeline, and G&A is growing as they gear up for potential launches.
Didn't they buy a company recently?
They did. Renovacor, back in December 2022, an all-stock deal. That's how they got the BH33 DCM heart program.
And how do they fund all this? Equity raises.
Historically, yes. Raised about $1.2 billion that way since they started, up to the end of 2024. They did another offering last December, raised about $182 million net. They also use ATM programs, selling shares into the market gradually.
No dividends or buybacks, obviously.
No, typical for their stage, all cash goes back into the pipeline. That December offering price was well below the stock's peak, which might reflect tough market conditions or just their need for cash.
So success with the pipeline is key to getting better terms on future funding.
Absolutely. Positive data de-risks the story and makes raising capital easier and hopefully less dilutive.
Right, let's dive into Chapter 3, financial health. What's the bottom line look like?
Well, the top line is zero product revenue, as we know. On the income statement, R&D spend was actually down a bit in 2024 compared to 2023, and that trend continued in Q1 25.
Interesting, with late-stage trials running.
Yeah, it could be efficiencies, trial phases ending, maybe some strategic shifts. They did have some R&D headcount reduction in Q1 25 too. Meanwhile, G&A costs went up. That's the commercial prep. That loss for 2024 was about $259 million. And Q1 25 loss was $61 million, which was actually a bit better than analysts expected.
Okay. What about the balance sheet? Cash on hand.
As of March 31st, 2025, they had about $318 million in cash equivalents and investments. That's down from $372 million at the end of 2024.
Any significant debt?
Not much traditional debt, mostly lease obligations. Share count is just over 106 million.
And cash flow? Burning through much?
Oh yeah, operating cash flow is consistently negative. Around $210 million used in the last 12 months. Free cash flow also negative. They did have positive investing cash flow in 2024, but that was mainly from selling investments.
So no profits yet, costs driven by R&D and that rising G&A. That R&D spending dip is worth watching, though.
Yes. You want to make sure they're not cutting back in ways that hinder progress, but maybe it's just better cost management. The G&A rise is necessary prep work, but it adds to the burn. We'll see how effective that spending is if they get approvals.
Given the cash and the burn rate, what's the runway look like? How long till they need more money?
Okay, with the $318 million at the end of Q1, they guided that it's enough to fund operations into Q4 2026.
That's a slight extension from before.
Yeah, previously they said Q3 26. So even with less cash than the end of 2024, the runway stretched a bit. Suggests they're managing costs, maybe that lower R&D spend.
But Q4 2026 is right around when that big Danon data is due, and maybe the Fanconi anemia BLA finalization.
Exactly, cutting it close. It seems very likely they'll need more funding before then, probably sometime in 2025 or early 2026.
And the terms of that funding will depend heavily on how things are going.
Totally. Good news means better terms, less dilution. Bad news makes it tougher.
Any key financial ratios worth mentioning, even for a pre-revenue company?
Well, price to book is interesting. It's around 1.5 to 1.8. That means the market values the company higher than just its net assets on the books.
Reflects the value of the pipeline, the IP. Right?
That's the idea. Investors are betting on future potential. Other ratios like ROE, ROA, ROIC are all negative, of course, because there are no profits yet. That PB above 1 is the market saying, We see potential value here beyond the current assets. Whether that's justified depends on future success.
Okay, we've covered a ton in this first half. The business model, the pipeline, the leadership, the financials. A complex picture.
It's definitely a lot to digest.
When we come back, we'll get into market sentiment, ownership, the risks in more detail, and try to pull it all together. Stay with us for the second half of our deep dive on Rocket Pharmaceuticals.
Welcome back. We're diving back into Rocket Pharmaceuticals. Second half, Chapter 4, Market Sentiment. What's the vibe out there? How are investors and analysts feeling about RCKT? Well, it's definitely a mixed bag, which makes it interesting. As of May 8th, the stock was around $7 a share, up a bit from earlier that week. Market cap somewhere in the $750 to $830 million range, varies a bit by source.
And you mentioned volatility earlier. Still true.
Oh, very much so. Big swings, weekly, monthly. The 52-week range tells the story. Low of $4.55, high near $27. That's classic clinical stage biotech volatility for you. High risk, potential high reward reflected right there.
Makes sense. What about standard ratios? PE is obviously out.
Yeah, no earnings, so no PE. Earnings per share, EPS, is negative, about negative $2.73 for the last 12 months. Analysts are forecasting losses for 2025 too, maybe around negative $2 per share, give or take. Q1 EPS was actually better than expected, negative $1.56.
Okay. And the analyst community overall, you hinted at optimism before.
Generally, yes.
Yeah.
The consensus rating is a strong buy. Average price targets are pretty lofty, clustering around $39, $40.
Wow, compared to $7 now.
Exactly. But the range of those targets is huge. Lowest is around $15, highest is up at $55.
That's a massive spread.
It really is. You've got bulls like BMO, Wedbush, Needham seeing huge upside. Then you have Goldman Sachs, more cautious with a neutral rating and a lower target. That wide range just screams uncertainty and differing views on the pipeline's chances.
So who actually owns the stock? Any big players?
Oh, yeah. Institutional ownership is very high. Reports vary slightly, but it's well over 100 million shares held by institutions like RTW Investments, Wellington, BlackRock, Vanguard, Maverick Capital. Big names.
And we talked about the insiders, recent buying from the CEO and CO.
Right, which is often seen as bullish. But again, looking longer term, there's been more selling than buying from insiders overall. So a bit of a mixed picture there too.
Okay, now for the really interesting part sometimes, short interest. Are a lot of people betting against Rocket?
Quite a few, actually. Short interest is significant, around 13.3 million shares shorted. That's a hefty percentage of the shares available for trading, something like 13–16%, depending how you calculate the float.
So definitely a battleground stock.
Absolutely. Strong opinions on both sides. But here's a twist. The options market looks more bullish.
How so?
The put-call ratio is really low, like 0.3 or even 0.2 recently. That means way more people are buying call options, betting the price goes up, than put options, which bet on a price drop.
Huh. So you've got bullish analysts, high institutional ownership, bullish options traders,
Yeah.
but also really high short interest.
Exactly. It's a fascinating setup.
Yeah.
Polarized views. Insiders buying recently and the options market lean optimistic, while the short sellers are clearly skeptical about the pipeline risks or upcoming catalysts.
Okay, Chapter 5 in the research is ownership structure, but it feels like we just covered the key points: high institutional ownership, notable firms, the insider situation.
Yeah, I think we've got the picture there. Lots of institutions have a stake. Insiders recently showed some confidence with purchases, but there's that longer-term selling history. It tells you who's got skin in the game.
All right, let's move to Chapter 6, risk assessment. This is crucial for any potential investor. What are the big red flags or potential pitfalls?
Top of the list has to be clinical trial and regulatory risk. It's just inherent in gene therapy.
High failure rate.
High uncertainty, definitely. Trials might not show efficacy or safety issues could pop up. And the regulators, FDA and EA, have high bars. They can be unpredictable, have different demands. That Chrysladia manufacturing review delay is a perfect example. Rocket even highlights these risks up front in their filings.
Makes sense. What else? Competition?
For sure. Gene therapy is hot. Rare diseases are hot, lots of companies piling in. Others might be working on the same diseases, maybe with different tech, small molecules, biologics, other gene therapies. And science moves fast. A breakthrough elsewhere could make Rocket's approach less competitive.
Financial risks seem obvious given their pre-revenue.
Absolutely. History of losses, burning cash. They rely heavily on selling stock, which dilutes existing shareholders. They will need more money before they're profitable. And biotech stocks swing wildly on news and sentiment. RCKT is definitely sensitive.
Are there broader market risks too?
Yeah, you can't ignore the macro environment. Biotech sentiment waxes and wanes. Things like inflation, interest rates, geopolitical instability, recession fears, they all affect investors' appetite for risk, especially in biotech.
And what about just making these things, manufacturing risk?
Huge one. Gene therapy manufacturing is incredibly complex, demanding, expensive. Quality control, purity, scaling up production, major challenges. Having their own AAV facility helps, but that has its own execution risks and costs. Plus, they rely on specialized suppliers, so supply chain disruptions are a potential issue.
And finally, protecting their discoveries, IP risk.
Always a factor. Getting patents granted, defending them if challenged, making sure they're broad enough to keep competitors at bay, it's critical and never guaranteed.
So pulling all those risks together, what are the most immediate ones to watch right now?
I'd say two things stand out. First, that Kresladiya regulatory decision. Getting that resolved positively or negatively will be significant. Second, the upcoming clinical data. Initial phase 1 for RPA 601 very soon, and the RPA 501 Danon program update mid-year. Those are huge potential inflection points.
And the financial risk is tied directly to those, right?
Exactly. Good data makes raising money easier and cheaper. Bad data makes it much harder, potentially more dilutive.
Okay. Chapter 7 is the wrap-up, the brief conclusion. How do we summarize Rocket?
It's really a compelling but definitely complicated story. You've got this potentially groundbreaking science aimed at really terrible diseases, a pipeline with high-stakes readouts coming, an experienced team.
But financials typical of a development stage biotech burning cash, needing more soon.
Right, and this fascinating split in market sentiment. Bullish analysts and institutions versus very high short interest encapsulates the whole thing.
High risk, high potential reward. That seems to be the label.
That sums it up perfectly. And those near-term catalysts we just mentioned, Kresladiya decision, the RPA 601 and RP 501 data, they are absolutely pivotal. They will likely be major determinants of the company's value and direction in the coming year or two.
So we started off talking about the potential for miracle cures. Investing in a company like Rocket, it really feels like a bet on that scientific progress, doesn't it? A bet on transforming lives.
It fundamentally is. That's the ultimate upside.
But with everything we've discussed, the huge potential rewards, but also those very significant, very real risks, the big question for you, the listener, is where do you see Rocket Pharmaceuticals heading?
That's the multi-million-dollar question indeed. And the answer really depends on how those next few chapters of their story unfold, particularly with the upcoming data and regulatory news.
For more deep dives like this and real-time updates on companies like Rocket, make sure you subscribe to the Stock Analytics AI YouTube channel.
And just a reminder, everything we discussed today is based on public information available as of May 8th, 2025. It's for informational purposes only.
Definitely not financial advice. And this analysis did incorporate information potentially generated or assisted by AI. We strongly encourage you to do your own thorough research before making any investment decisions.